Managing your money can feel overwhelming, especially when you're juggling multiple expenses, savings goals, and the pressure to plan for the future. It's easy to get caught up in the cycle of earning, spending, and feeling like there's never enough left over. But here's the truth. Taking control of your finances isn't about earning a massive paycheck or mastering complex financial strategies. It's about taking small, deliberate steps that lead to big results over time. As someone who has worked as a qualified accountant and a former investment banker, I've seen how much of a difference these small, thoughtful actions can make. Whether it's someone trying to get out of debt, build savings, or plan for their retirement, the same 6 principles consistently come through as game changers. These aren't just theories, they're tried and true methods that work for people from all walks of life. Why is this important? Because money isn't just about numbers, it's about freedom, security, and the ability to live your life without constant stress about what's in your bank account. When you take charge of your finances, you're not only improving your financial health, but also setting yourself up for peace of mind and long-term stability. Let's break it down. Each of these 6 steps represents a crucial piece of the financial puzzle. They're designed to help you take control of your income, reduce financial stress, and prepare for both short-term challenges and long-term goals. These steps aren't complicated, and you don't need a background in finance to follow them. What you need is a commitment to start, the willingness to stick to the plan, and a clear understanding of how these steps fit into your life. With every step you take, you're building a stronger financial future for yourself and your loved ones. Let's dive into these 6 powerful steps and explore how they can transform your relationship with money. Step number 1. Calculate your financial baseline. Your financial baseline is the starting point of any solid money plan. It's all about figuring out how much you're spending on your essential living costs. These are the non-negotiables in your budget, like rent or mortgage payments, transportation, groceries, and utility bills. By understanding this number, you can take control of your finances and ensure you're living within your means. The key goal here is to keep these essential expenses under 60% of your take-home pay. That's the amount of money you actually have after taxes and other deductions are taken out of your paycheck. Why 60%? Because it leaves room for saving, paying off debt, and enjoying life without overextending yourself financially. Here are some simple and actionable tips to calculate and manage your financial baseline. 1. Track your expenses. The first step is knowing exactly where your money is going. You can't fix what you don't measure. Use budgeting tools like YNAB, You Need a Budget, or Mint to keep track of your spending. These apps make it easy to categorize your expenses, identify patterns, and highlight areas where you might be overspending. Even a simple spreadsheet or notebook can work if you prefer a hands-on approach. Number 2. Look for ways to cut back. Once you know what you're spending, look for opportunities to reduce costs. Small changes can make a big difference over time. For example, meal prepping. Instead of eating out or buying expensive ready-made meals, plan your meals for the week and cook at home. It's healthier and saves money. Public transport or carpooling. If you're driving everywhere, consider using public transportation or joining a carpool. It's often cheaper than the costs of fuel, maintenance, and parking. 3. Review your subscriptions. How many subscription services are you signed up for? From streaming platforms to gym memberships, these costs can add up quickly. Take a hard look at your subscriptions and ask yourself, do I really use this service? Is there a cheaper alternative? Can I share this subscription with a family member or friend? Cancel anything you're not using regularly. You'll be surprised at how much money you can save by cutting out unnecessary services. By calculating your financial baseline and keeping essential expenses under 60% of your income, you're creating room in your budget to save, invest, and plan for the future. This simple habit is the foundation of good financial health and puts you on the path to a stress-free relationship with money. Step number 2. Build a 1-month emergency cushion. Life is unpredictable, and unexpected expenses can pop up when you least expect them. Your car might break down, your boiler might stop working, or you might face an urgent medical expense. These moments can be stressful, especially if you don't have the money set aside to deal with them. That's where a 1-month emergency cushion comes in. This cushion is simply 1 month's worth of your essential living costs, things like rent, groceries, transportation, and utility bills, set aside in a savings account that's easy to access. It's your safety net for life's small surprises, giving you peace of mind and financial stability. Here's how to start building your 1-month emergency cushion. 1. Set up automatic transfers to a savings account. Saving can be hard if you rely on willpower alone. That's why automating your savings is a game changer. Set up an automatic transfer from your main account to a separate savings account as soon as your paycheck comes in. For example, if you can afford to save $50 per week, set up an automatic transfer for that amount. Over time, these small, consistent contributions add up without you even noticing. Automating the process takes the guesswork out of saving and ensures you stay on track. 2. Start with small, manageable amounts. If saving a full month's worth of expenses feels overwhelming, don't worry. It's okay to start small. The key is to focus on steady progress. Even putting away $20 or $30 at a time can make a difference over the long term. The important thing is to make saving a habit. Think of it like building a muscle. The more consistent you are, the stronger your savings will grow. Every little bit you save gets you closer to your goal. So don't underestimate the power of small steps. 3. Use a high-yield savings account. Once you've decided to save, make sure your money is working for you. A high-yield savings account is a great place to keep your emergency cushion. These accounts offer better interest rates than standard savings accounts, so your money grows a bit faster over time. Look for accounts with no fees and easy access. You want to be able to get your money quickly if an emergency happens, but you also want it to earn as much interest as possible while it's sitting there. Building a 1-month emergency cushion is a simple but powerful step toward financial security. It protects you from the stress and worry of unexpected expenses and gives you the confidence to handle life's challenges without falling into debt. Start small, stay consistent, and watch your savings grow. You'll thank yourself later. Step number 3. Pay off high-interest debts. Debt can feel like a heavy burden, especially when it comes with high interest rates. If you're paying interest rates above 7%, it's important to focus on getting rid of that debt as quickly as possible. Why? Because high-interest debt eats into your financial progress, costing you more money over time and making it harder to save or invest for the future. The good news is that with a focused plan, you can take control of your debt and free up money to use for things that truly matter. Here's how to prioritize paying off high-interest debts effectively. 1. Use the avalanche method. The avalanche method is one of the most effective strategies for tackling high-interest debt. It's simple. List all your debts, starting with the one that has the highest interest rate. Pay as much as you can toward that debt each month, while continuing to make the minimum payments on your other debts. Once the highest interest debt is paid off, move on to the next one on your list. By targeting the most expensive debt first, you'll save the most money in interest over time. It can take patience and discipline, but the financial relief you'll feel when that debt is gone is worth it. Number 2. Consolidate debts into a lower interest loan. If you have multiple high-interest debts, consolidating them into a single loan with a lower interest rate can make repayment more manageable. This strategy works best if you have good credit and can qualify for favorable terms. For example, you might take out a personal loan with a lower interest rate to pay off higher interest credit card debt. Or, you could transfer your credit card balance to a card with a 0% introductory APR, annual percentage rate, for a set period. Just be sure to read the terms carefully and avoid using the card for new purchases while you're paying off the balance. Debt consolidation can simplify your payments and save you money in interest, but it's important to stay disciplined. Don't take on new debt while you're working on paying down the consolidated balance. Number 3. Avoid accumulating new high-interest debt. While you're focused on paying off what you owe, it's crucial to avoid adding more high-interest debt to the pile. This means rethinking how you use credit cards, payday loans, or other forms of debt with high interest rates. Here are a few tips to help you avoid new debt. Stick to a budget and live within your means. Use cash or debit instead of credit whenever possible. If you must use a credit card, pay the balance in full each month to avoid interest charges. Breaking the cycle of high-interest debt is one of the best things you can do for your financial health. It might require some sacrifices in the short term, but the long-term benefits are well worth it. By prioritizing the repayment of high-interest debts, you'll free up money that would have gone toward interest and regain control of your finances. This step is all about building a stronger foundation for your financial future, one where your money works for you, not against you. Stay focused, stay disciplined, and watch your progress grow with every payment you make. Step number 4. Max out workplace pension contributions. If your employer offers to match your pension contributions, it's one of the easiest and most effective ways to grow your retirement savings. Think of it as free money that gets added to your account, boosting your future financial security without requiring much extra effort on your part. Yet, many people either don't take full advantage of this benefit or delay contributing, missing out on a huge financial opportunity. Here's why maximizing your workplace pension contributions is so important. 1. Matching contributions. Boost your retirement savings. Employer matching means your company will contribute a certain amount to your pension plan based on how much you contribute. For example, if your employer matches up to 5% of your salary and you contribute 5%, they'll match that amount, doubling the total going into your retirement account. This match is essentially an immediate 100% return on the money you put in, something you won't find with most other investments. By not taking advantage, you're passing up an opportunity to significantly increase your retirement savings with minimal effort. 2. Missing out on this benefit means leaving money on the table. The unfortunate truth is that if you don't contribute enough to qualify for the full employer match, you're leaving money on the table. This is money your employer is willing to give you, but only if you make your contributions. It's like being offered a bonus and turning it down. Even if you feel like you can't afford to contribute the maximum amount right now, try to increase your contributions gradually. Start with whatever amount you can afford and work your way up. Every dollar you contribute brings you closer to unlocking the full match. 3. Act early to maximize growth through compounding interest. One of the biggest advantages of contributing to a workplace pension is the power of compounding interest. When you invest in a pension plan, the money you contribute earns returns, and those returns earn returns. Over time, this compounding effect can lead to substantial growth in your retirement savings. The earlier you start, the more time your money has to grow. Even small contributions made consistently over many years can add up to a significant nest egg by the time you retire. By maxing out your contributions early, you're giving your investments the best possible chance to grow and support your future financial goals. Taking full advantage of your employer's pension match is one of the smartest financial moves you can make. It's free money that grows over time, helping you build a secure future without requiring a big upfront commitment. Don't miss out. Start contributing today and watch your retirement savings flourish. Step number 5. Build a 6-month emergency fund. After tackling high-interest debts and taking advantage of employer matching for your pension, it's time to focus on creating a stronger financial safety net. A 6-month emergency fund. This fund is designed to protect you during larger, life-altering emergencies like job loss, major medical expenses, or other unforeseen events that might significantly disrupt your income or increase your costs. Having this financial cushion provides peace of mind, ensuring that you can cover your essential living expenses without turning to high-interest debt or depleting your long-term savings. Here's how to build and maintain your 6-month emergency fund. 1. Keep the funds in a separate, easily accessible account. It's important to keep your emergency fund separate from your everyday spending account. This way, you're less tempted to dip into it for non-emergencies. Choose an account that's easy to access when needed, like a high-yield savings account. These accounts offer better interest rates than traditional savings accounts, so your money grows a little while it's sitting there. Avoid tying up this money in investments or accounts with withdrawal penalties. It's meant to be available quickly when you need it. 2. Adjust the amount based on your personal circumstances. The general rule is to save 6 months' worth of essential living costs, but your exact amount might vary depending on your situation. Consider factors like job stability. If you work in an industry prone to layoffs or have variable income, you might want to save more than 6 months' worth. Dependence. If you have a family relying on your income, you may need a larger cushion to cover their needs as well. Cost of living. If you live in an area with high living expenses, your emergency fund will need to reflect that reality. Tailor your fund to suit your life and ensure it provides adequate coverage for your unique needs. 3. Revisit your emergency fund periodically. Once you've built your fund, don't forget about it. Your financial situation and expenses can change over time, so it's a good idea to review your emergency fund regularly to make sure it's still sufficient. For example, if your rent goes up, you take on new responsibilities, or your income increases, you might need to adjust the size of your fund. Periodically revisiting your fund ensures it remains aligned with your current needs and provides the right level of security. Building a 6-month emergency fund takes time and effort, but it's one of the most important steps you can take to safeguard your financial well-being. By setting this money aside, you're giving yourself the freedom to navigate life's challenges without panic or financial strain. Start small, be consistent, and before you know it, you'll have a safety net that brings you peace of mind and financial stability. Step number 6. Start investing in tax-free accounts. Once you've established financial stability with your emergency funds and reduced debt, it's time to grow your wealth by investing. Tax-free accounts, such as individual savings accounts (ISAs), are excellent tools for this purpose. These accounts allow your investments to grow without being taxed on the gains, dividends, or interest earned. This tax advantage means your money grows faster compared to taxable accounts, making it a smart way to build long-term wealth. Here's how to get started. 1. Begin with low-cost index funds or ETFs. For beginners or even seasoned investors, low-cost index funds or exchange-traded funds, ETFs, are great options. These investment vehicles offer diversification. They spread your money across a wide range of companies or assets, reducing the risk associated with putting all your eggs in one basket. Low fees. High fees can eat into your returns over time. Index funds and ETFs typically have lower costs compared to actively managed funds, meaning more of your money stays invested. Ease of access. Most tax-free accounts offer a variety of index funds and ETFs to choose from, catering to different risk levels and financial goals. Starting with these options simplifies the process and allows your money to work for you without requiring extensive knowledge or constant management. 2. Contribute regularly, even if it's a small amount. Consistency is key when it comes to investing. You don't need to invest a large sum up front. Even small, regular contributions can grow significantly over time thanks to the power of compounding. Set up automatic contributions to your tax-free account to ensure you're investing regularly. This habit not only builds discipline, but also helps you take advantage of dollar-cost averaging, where you buy more shares when prices are low and fewer when prices are high, smoothing out market fluctuations over time. Number 3. Reinvest dividends to maximize compounding. If your investments pay dividends, reinvesting them instead of cashing them out can accelerate the growth of your portfolio. Reinvested dividends buy more shares, which then generate more dividends, creating a compounding effect. Many tax-free accounts offer an option to automatically reinvest dividends, making it easy to put this strategy into action. Over time, the impact of reinvested dividends can significantly increase the value of your investments, especially if you start early and stay consistent. By starting to invest in tax-free accounts, you're taking an important step toward financial independence. These accounts provide a tax-efficient way to grow your money, ensuring more of your hard-earned cash stays invested and working for you. With simple, consistent actions like contributing regularly and reinvesting dividends, you'll be well on your way to building a secure financial future.